Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for Wednesday, November 18th. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Today, the S&P 500 was down 1.16%, and we closed at 3567.79. The first chart that we're going to look at is a one-day, 1-minute chart of the S&P 500, so each candlestick does represent 1 minute of trading. The dotted blue line is where we closed yesterday. So you can see here over in the upper left where my cursor is moving, this is where we opened, about where we closed yesterday, and we actually had a positive day going on for the first half of the day. But you can see, or at least the first part of the day, but you can see just after noon, the market started to weaken and we went negative just before 1:30 in the afternoon and continued to sell off, and we closed at the absolute dead lows of the day, again down 1.16%, and we closed at 3567.79. The next chart that we're going to look at is a 10-day, 10-minute candlestick chart of the S&P 500. So each candlestick does represent 10 minutes of trading. The blue line is set at 3,600. And of course, the last 2 days, Monday and Tuesday of this week, we had closed above 3,600. And that is the only 2 days in the history of the S&P 500 where we did close above 3,600. Now that we've once again closed below 3,600, 3,600 becomes the overhead resistance point on the S&P 500. But it does look like we probably have further downside, so we'll take a look at that over the next chart as well. But the first thing I want to do here, and let's annotate this together, I want to draw a trend line to show you what I was seeing. And if you didn't see last night's video, I would encourage you to watch that, and of course go back and watch Mondays and last Fridays as well. But on this 10-minute chart, it's quite easy to see this downtrend. And let me just save these changes real quick. It'll be easier for all of us to see this. Look at this downtrend line that I just drew, and you can see connecting the high point from last Monday on November 9th. And of course, that's the day that Pfizer came out with their news on the testing that they've done on their coronavirus vaccine. And you can see here that since this high point, and this was really right at the open of trading on the 9th, you can see that we've been making lower highs and really have been in a downtrend since then. And on Monday, the 16th, Moderna came out with their news, which in my opinion was as good or better than the Pfizer news, but we never got back to those highs. And you may remember that on last night's video, I was talking about this. Well, you can see exactly why I was worried about this. And we have now, of course, closed beneath 3,600. And, we probably have more weakness coming our way over the next couple of days. The next chart that we're going to look at is a 1-year daily candlestick chart of the S&P 500. So each candlestick on this chart does represent 1 day of trading. And several things I want to point out on this particular chart. Here is, of course, where we closed today. And this first blue line is set at 3420. Now, any of you that have been watching my videos over the last couple of weeks, I've been talking about how important the 3420 support level is. But what we can also see here is this green line. That's the 50-day moving average. And I have drawn this circle to really highlight this. But the 50-day moving average and this first support line are almost identical. They're lining up, okay? So the 50-day moving average is setting just over 3418, and of course 3420 is where this first support level is at, below where we're currently trading. Guys, there might be a little support at 3525, but realistically, it's not going to hold, okay? 3420 is really the first level of true support below where we are currently trading, and it's interesting that that lines up almost perfectly with the 50-day moving average. So I think at the very least, a realistic downside here is the 3420 area on the S&P 500. Now, if the selling gets worse and we close beneath the 3420, of course, the 50-day moving average, then we would most likely fall to at least the 3330 area, which is this next blue line. And you can see that this support level goes clear back to the first part of the year where we traded right up to the 3330 level in January, had a few days where we traded above it in February, and then, of course, it acted as a support and resistance area for really August and on. All right, and of course, if 3330 doesn't hold, then 3210, you can see the trading around this 3210 area throughout the bulk of 2020 and even going back into December of 2019 right there. And if 3210 doesn't hold, then we get down to the 200-day moving average, which is where this blue line is, and that's the blue line, the 200-day moving average, and where this arrow is. Okay, and again, that's about 13% between where we're at and the 200-day moving average. So I really do think that we probably have a little bit more downside here, guys, over the next few days or even few weeks. There's no way for any of us to know exactly how far we will fall, but these are the critical levels to watch. And guys, if you like my charting and you like my work, but you want even more information, more insights, you want the best that I can deliver, please pay close attention to the rest of this video where I'm going to introduce you to Simple Market Signals, which is my own personal risk management model. It took me over 20 years of research to develop this model, and I'm making it available to you for less than $20 per month. And with that said, please pay close attention to the balance of this video. Let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green. And the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how simple market signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over and that things were changing. And so I gave people a heads up right here over the weekend. And I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the simple market signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this simple market signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal. We had the general trend indicator went negative. And then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, and it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October, and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the simple market signals model, there are three powerful indicators. There's the simple market signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in this Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, okay, understand that everything is tied to your email on file. All right, so once you subscribe, you go out to the website simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy, and you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information, and you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in-basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend. All right. So the goal is to get it out Saturdays by 2 p.m., but it could be any time over the weekend, depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition, right, once you subscribe, understand that the next edition, right, so if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday. All right, and then once you subscribe, we will send you as soon as we can the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders, because it's probably hidden in there. All right, so you should get the automatic welcome letter, and then the latest edition within the next day or two of your subscription. And then again, the standard newsletter goes out every weekend, but we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.